Hello, ladies and gentlemen. Thank you for joining us. My name is Kiril Tsenkov, and today I'm going to be hosting the trend following webinar at GDMfx. Now, before we start, I would like to use this opportunity to thank each and every one of you for joining our webinar, and of course to remind you that we will be making regular stops to answer all relevant questions during today's broadcast. So if anything comes to mind which you would like to ask, which you would like me to address as a question, please by all means just use the raise your hand button or the little chat feature of our webinar system so that you can send us your questions. And as I said, every now and then we'll be making a short stop. We'll be covering all relevant questions before continuing with the presentation. Of course, if anything comes to mind later on after today's webinar is concluded, you can always use the email webinar@gdmfx.com to send us your questions, and we'll make sure to reply to you as soon as possible. Okay, excellent. Today's topic, once again, is trend following and how exactly we can do it, how exactly we can follow the trend as a professional, how we can benefit from it, what it is, and of course how it can be useful for us. One of the most important things I should mention from the very beginning is that by all means trend following and the concept of trends are amongst the oldest technical methods of trading the market, the oldest forms of technical analysis, and they are extremely powerful and are being heavily used up to this day, especially in longer term trades. Now, what we are going to talk about today is basically we are going to define what is a trend. We are going to talk a little bit about the Charles Dow theory of the trending markets, which basically marks the beginning of trend following the financial markets. We are going to explore the most popular ways of identifying a trend on your chart, the most popular and widely used ways of measuring it in terms of its strength, in terms of its reliability, and obviously we're going to demonstrate a very popular, very simple and yet extremely powerful technique you can use to trade trends, to follow the trends, which is also widely known as a type of swing trading. Now, once again, my name is Kiril Tsenkov, and if you have any questions during the session, please feel free to use the little chat feature of our webinar system or to click the raise your hand button. We will be making regular stops to answer all relevant questions, but even if your question is not really relevant to today's topic, you will still receive an answer by all means. We will just send it to you via email as soon as today's webinar is concluded. Right, moving on with the first order of business. Today we are going to define what a trend is. And basically there are two aspects to defining a trend. And obviously there are several types of trends in terms of those two separate aspects. Now, in terms of importance, there are a few types of trends, and in terms of direction, there are a few types of trends as well. First off, we are going to talk a little bit about the different types of trends in terms of their importance on the market. And then we are going to address the issue of direction. Right, there we go. Now, basically, in terms of importance, what we can say is that, and you will hear this very frequently in our morning outlook or in your daily article about the market or any informational website you might use, you will every now and then hear the phrase major trend or intermediate trend. You will also hear secondary trend. So major, secondary, intermediate, these are three types of trends in terms of their importance. A major trend is something that is, we could, as a matter of fact, also call it a long-term trend. It's something that you will be able to spot or identify or notice on your daily chart, on your weekly chart, in other words, on a longer period chart, on a bigger scale. Secondary trends are basically, and let me demonstrate this on your screen real quick. So if you look at the green line, the green arrow, I should say, let me just circle it for you real quick. So if you look at this little green line, this is what we could, for the purposes of our example today, call a major trend, long-term trend. We can clearly see a directional movement of the market to the upside, so we can say that this is an uptrend. Now, when talking about a secondary trend, we could say that the secondary trends are basically the building blocks of the major trend. So if we consider smaller directional movements like this up movement, and that up movement, and that up movement, we can call those our secondary trends, secondary uptrends. If we, on the other hand, consider that little down movement or that one, then we can say that those are our secondary downtrends. In other words, the little pieces that build the major trend, this is what we can call the secondary trends. And in the same fashion, of course, the intermediate trend is little building blocks of the secondary trend. So they're even smaller trends which put together comprise the bigger secondary trend. Now, we already mentioned that a major trend is something we can spot on a bigger time frame, on a bigger scale, like a daily chart or a weekly chart. Secondary trend is normally something we would be looking at on our hourly charts, 1 hour, 4 hour charts. And then if we go into the even smaller periods, like the 30-minute or the 15-minute or even the 5-minute, that's where it will be the easiest for us to spot the intermediate trends, the really short-term trends, sometimes referred to as intraday trends by day traders and so on. Now, in terms of importance, once again, we have given you the three types of trends. Now, obviously, the long-term one, the biggest one, the major trend, the direction of the market over days and months, that's what we are going to call the most important trend. Now, we can see a reversal, we can see a change of direction on the market in a period of 30 minutes, probably 30 times. We can see a change of the major direction of the market a few times a day in the hourly chart. But when we are considering the daily chart, then a major change of the market direction from up, let's say, trend to downtrend, that's something that doesn't happen every day. It's the beginning of a serious profit potential for whoever's able to open his position at that exact point of time. So by all means, the most important type of trend and the strongest type of trend would be the major trend, the biggest one, the long-term trend. Now, this information will get quite useful. You will be able to fit it in the puzzle as we move along, as we proceed further, especially when we go into our examples on the actual chart itself. But for now, we can just, as a summary, we can just say that the bigger the time frame of the trend is, the more important and the stronger it is. Now, talking about direction, we already mentioned that in terms of strength and importance, there are major trends, secondary trends, and intermediate trends. But in terms of direction, there are three types of trends as well. The so-called uptrend, which you're seeing on your screen right now, the downtrend, and something we like to call the sideways movement. There are a lot of analysts and a lot of traders who would say that when the market is moving sideways, it's not actually a trend. They would specify trends only as uptrends and downtrends. But the most correct way to actually go about this is to consider sideways movement of the market as a trend itself. Now, what we're looking at on our screen are a couple of examples of an uptrend. On the left side, we see something that we drew up for convenience, and on the right side, we actually see a screenshot of our of an actual uptrend on the daily chart of the Euro USD, which we took from our Metatrader. Now, this brings us back to our definition of a trend. Once again, it's a series of directional movements on the market. If those movements are proceeding higher and higher to the upside, in other words, we would call it an uptrend. And in order for a specific series of directional movements to be called an uptrend, we would like to observe a few conditions. You actually see those conditions on the left side of your screen right now. What we want to see in order to identify an uptrend is we want to see a series of higher highs. And just a second, let me mark those for you. For example, here, here, and here. Or if we consider the right side of the screen, see it here, and then we'll see it here, so on. So our first condition is a series of higher highs. Every next high market reaches must be higher than the previous high. The second condition we would like to see is a series of higher lows. Let me once again mark that for you. Now, every low must be higher than the previous one. So you can see that on the left side of your screen right now. And let me mark it on the right side of your screen on the chart as well. So we can see that every next low is even higher than the previous one. Now, if we see this, if we see those two conditions, higher highs, higher lows, then we can basically say that this is an uptrend. It's as simple as that to actually define an uptrend. Now, whether this uptrend is too fast, whether it's not fast enough, not strong enough, whether we can rely on it, that's something else, which we're going to talk about, and we're going to measure it on our chart. This is what we mean by measuring a trend. But as long as we see higher highs and higher lows, then we can say that this is an uptrend. Now, there is something which I'm sure many of you are noticing already when considering an uptrend. For instance, by comparing the left side and the right side of your screen right now, there are certain similarities in the way the actual trend looks. We see that every time the market pushes higher and reaches a new high, after that it retreats back down. And this happens over and over again. There is a very rational explanation to this. It's actually quite close to mind. We are going to address it when we introduce the Dow theory to you shortly. But that is something that is absolutely mandatory in order for us to actually call something a trend. What we need in order to identify, for example, an uptrend, as the one that we're looking at right now, it's quite straightforward. Basically, if we consider that the trend is a line, like the blue line you see on the right side of your screen, then in order to draw a straight line, what one needs are at least two dots so that he'll be able to connect them. Now, a very important rule of thumb when identifying a trend is that if you're considering this to be an uptrend, then you connect only the lows. You need at least two lows. The very beginning of the trend, which is right here, and then the first low, let's say, right there. So if the market goes only up forever without retracing downwards at least once, then we couldn't really say that that's a trend that we would like to look at. Now, every trend would retrace sooner or later. And one of the major rules on the market, once again one of the rule of thumbs, is that you do not buy on the high if you're following an uptrend. You're buying on the low. You're waiting for the low before you buy. You don't get greedy or impatient. So if we see a movement up higher and higher of the market and we don't see that market retracing to the downside at least once, we basically do not have the second dot, so we cannot really connect them. We cannot draw our straight line. Now, all of this, of course, works exactly vice versa for downtrends. And as I see that some of you are asking how about downtrends already, let me use the opportunity to reassure you, yes, we're going to give you a couple of examples with the downtrend as well. And of course, in the next few minutes, we will actually load up the Metatrader and we will be able to draw it on the chart itself. And I'll show you a couple of useful technical indicators and useful tools in the Metatrader which you can use in order to identify, measure, and of course trade the trends. So once again, just to sum it up, we are looking at an uptrend and we are calling an uptrend a series of directional movements of the market where every next high the market reaches is higher than the previous one and every next low market reaches is lower than the previous, is higher, sorry, than the previous low. So series of higher highs and higher lows. I see a comment by one of you, they should be taking turns. Yes, by all means. Actually, it's a pretty good note. It's a valid point. Highs and lows should be taking turns. Yes, otherwise it will be a bit difficult to identify what is higher than what and what's lower than what. So if you see first low, let me demonstrate on the right side of your screen. What you should be looking at, what you should be seeing is the following sequence. First you have the beginning, which is a low, followed by one high. And then they should take turns. So the next thing you should see is a low. It should be higher than the previous low. Then you wait for the next high. It should be higher than the previous high. And so on. Yes, they should be taking turns. That's an excellent point. Now, if you just bear with me for a second, we will do the same demonstration with a downtrend. There we go. Now, I have left the left side of your screen blank on purpose. We're going to try to replicate what a downtrend is on our own right now. But as I already mentioned, a downtrend is quite simply put exactly the vice versa of an uptrend, exactly the opposite of an uptrend. So we have a series of lows followed by highs or retracement to the upside, then the next low, next high, and the next low, and so on. Now what we want to see here is the opposite of the uptrend. We want to be able to connect at least two dots, and if for an uptrend we are always connecting the lows, then for a downtrend we must always be connecting the highs. So if this right here is the beginning of the trend, let me highlight it for you, right up there in the left corner, then this would be the first high, right down here. So we want to connect those two dots in order to draw our straight line, and then we can see that it is a downtrend in exactly the opposite way of the uptrend. The downtrend, every next high is lower than the previous high, as you can see on the left side of your screen, and let me also mark it up on the right side of your screen. So every next high is lower and lower than the previous one. This is condition number one, and condition number two would be that every next low is also lower than the previous one. In other words, market keeps progressing lower and lower, keeps moving lower and lower. That would be our downtrend. Now we did mention the third direction, sideways movement, or also known as a ranging market, market stuck in a range. If we don't meet the conditions we've mentioned so far, for uptrend higher highs and higher lows, and for downtrend lower lows and lower highs, if we don't meet those conditions, then this is what we can call a sideways movement. Let me actually draw it up on the left side of your screen. So, something like this. That's what we can call sideways movement or sideways trend. Okay, no questions so far, but anyway, if anything comes to mind after we conclude today's webinar, please feel free to just send us an email over at webinar@gdmfx.com. We'll make sure to send you a reply as soon as possible. Right now, I'm going to click a button and we will be able to discuss who really started all of this, really started talking about the trending markets in the first place. And this most notably is the Charles Dow theory of the trending markets. It's more than a century old, but it's still one of the most important trading methods and technical analysis methods out there that is quite heavily used and quite frankly could be very, very successful for you as a trader. Now, what Charles Dow wrote in a series of articles a very long time ago is he basically said that markets are moving in directions. Those directions can be called trends. And furthermore, it is more likely for a trend to continue in the same direction than to reverse, which of course can mean basically a lot for the trader, simply because risk management is complex thing, and it revolves around measurement, analysis, and the weighing of different risks. Is there a higher chance for this or a lower chance for that? So whenever someone says that there is a higher chance, in fact, of the market to continue in the same direction if it's in an uptrend, then to reverse to the downside, that does mean a lot. Now the question, of course, is, first off, what's the rationale behind it? Why would this be a fact? Why is this happening? And second off, how can we really use it? How can we measure it? Now, you are seeing a beautiful picture on your screen, and that is for a reason. Basically, trends on the market, on the chart itself, can be compared to the ocean tides. For example, when the tide is coming in, you would see the waves pushing further and further inland. And every time a new wave goes further inland, this advance would be followed, as one of you just pointed out, they take turns, this advancement would be followed by a retracement, a retreat backwards. And as the tide is coming in, every next wave, every next advancement goes further into the beach and retraces by less back to the sea. And that's how you get most of your beach covered with water. On the same token, when the tide is retreating, the low tide, it's time for the low tide, what you're going to witness is that every next retreat of the wave goes further backwards towards the sea, and then every next advancement in the, towards the land, towards the beach, covers less and less of the land. So the advancement is followed by a retreat. And if the advancement, the high, the retreat, the low answer to our two conditions, then we'll be able to call this an uptrend or call that a downtrend. Now, what is the rationale behind all of this? Why Charles Dow basically claimed that it's happening? How did he explain this? That's a very interesting, very interesting story. And now we are actually going to go into our Metatrader chart so that we can understand the rationale behind the Charles Dow theory and the trending markets, and we can obviously learn how to use it to our advantage. Now, in my experience, I've noticed that it's always better for a trader to actually understand the system he's using or the type of analysis he's using, as in the long run that would obviously make him quite a bit more successful. Quite simply put, once again, it is better to understand why something works than just to use it. And for this purpose, let's consider the Metatrader chart right now. What I'm going to do is I am going to mark what appears to be the beginning of a trend. Right down here on the bottom left corner of your screen, you will see a red rectangle. Could say a square, but doesn't look quite like a square. So we'll call it a red rectangle. So I've used this to mark what I believe is the beginning of a trend. Let me just change its color for you real quick so that it makes the actual candles easier to spot. Ah, there we go. Now it's a green rectangle. So what Charles Dow would say is that every now and then a fundamental change on the market will happen, or will be close to happening. And big financial institutions and big traders and banks, so on and so forth, they will become aware of it, and they will consider the effect it is going to have on the market. So whenever the big institutions believe that the day is going to get quite better for the Euro USD, they would open up their long positions, they would buy the market, and they would wait for the price to go up so that they can get their profit. Now, as we know, the financial markets are basically driven by supply and demand, by buying and selling. Whenever the buyers or the bulls are stronger on the market, we would see the price going up, we would see the market rallying. And whenever uncertainty, fear, bears, sellers are stronger, when they prevail, we will see that as a result of too much selling and too many selling orders, we would see the market going down, the price going lower and lower, we would see the market crashing. So when the big institutions start buying, all of that buying would cause the market to rally, to start going up. And I'm sure that's something we can all agree to, especially in combination with a major fundamental change or economic news announcement, so on and so forth. So imagine the green rectangle on the bottom left of your screen. This is where all the big institutions will place their first buy orders. Now, as a result, we would see that the market starts going up in the next days. There is a major rule of thumb in the financial markets and trading the financial markets, and this rule is quite simple, and it does find its place in trend following as well, and in all types of trading, as a matter of fact. And it's particularly popular in big financial institutions, hedge funds, so on and so forth. And this is a very simple rule. You don't cut your profits and you don't run your losses. What I mean by this is I mean that you don't get itchy fingered when you see a small profit. You don't you should not be too quick to close the position. And when the market moves against you, you should know when to call it quits. You should know when to say enough is enough and just accept the loss instead of going deeper and deeper into a running loss. So what we are seeing here after the big institutions supposedly started buying is we're seeing that the market goes higher. And now at a certain point we would notice that it reaches a previous resistance level. Now, this resistance level, which I just marked with a not so beautiful dotted line, but nevertheless it's there on your screen, this would normally cause traders to get a bit anxious, a bit nervous, but we should remember our golden rule of thumb. We don't cut our profits. So the big risk management textbook at this stage would say that you should realize only a part of your position in order to secure yourself a certain profit, and then leave the rest of the position to work. So if the market continues even higher, you would still leave your profits running, be able to maximize the profits from this particular trading decision. And as a result, all the people that bought, all the companies that opened buy positions in the green rectangle, bottom left corner of your screen, they would not close everything here. They would liquidate, they would close half, let's say, or a portion of their positions, somewhere around here. Why? Because they're close to a resistance level and they cannot be sure if the market would be strong enough, if the price action would be strong enough to breach it and to proceed even higher. So the rational investor would secure a part of his profit just to make sure that if the market goes back down, at least he would come out with some profits. Now, this closing of a portion of the position of everyone is basically creating selling pressure. And as we already mentioned, when people were selling, when more of the people were selling, when sellers prevail, we would notice that the market starts going down. Hence, we have our first retracement to the downside. Now, what Charles Dow basically suggested that happens at this stage is that all of the traders that were not quick enough to buy in the green rectangle are now coming on the market and they are seeing what's going on, and they decided better enter late than never. So first off, we should consider the fact that if the first group of people and companies bought let's say one lot each at the green rectangle, then at the dotted line they didn't close everything, they sold only half of their position, so let's say half lot each, which would drive the price down, but logically speaking should not push it as low as it originally was, simply because selling now is half in volume as buying earlier on. All of that in combination with the fact that now we would have new people coming in who decided it's better to participate late rather than never, and they start buying again, and that's how our next wave pushes even further into the beach, or in other words, that's how we get our next advancement even higher. And once again, when we reach the second high, this is where rational investors would decide to cash in on part of their positions, not all of them, but part of them, in order to secure even more profit. They would leave the rest running in order to try to maximize the result of their trading decision. So, once again, for some reason, the market participants would feel anxious at the second higher dotted line. So in order not to risk everything there, they would liquidate on the second part or on the first part of their position. Depends on which rectangle they entered the market in. And as a result, from that selling, we would get our second retracement. Now we have quite a few dots to connect here. We already have more than two lows. But we can see that each and every one of them is higher than the previous one, and each and every one of the highs is higher than the previous one. So by all means, yes, we can call this a beautiful uptrend. And given in mind the fact that it's on the daily chart, then we can actually say that it's a major uptrend as well, which makes an important one and a strong one. Now, just to sum up the rationale behind the trending markets theory of Charles Dow, for curiosity's sake, I should mention that this theory in itself was never actually published by Charles Dow. And actually Charles Dow, of course, as we all know, used to be the founder. He was the founder of the Wall Street Journal and one of the founders of the Dow Jones Industrial Index. In other words, by all means, he was a person who really knew what he was doing on the market and is to this day considered the father of technical analysis. So what he said is that when the big institutions, the big traders, the people who are in the know, who have the knowledge and the information and the power, when they realize that the market is about to go up, they will start buying all of them. And this in itself will cause pressure to the upside, start moving prices higher and higher. It will create a rally. And when this rally reaches close to the first resistance point, which bothers the buyers, they would not close everything, but they would liquidate a portion of their position, by rule of thumb, around half of whatever they have working, which temporarily, all of this temporary selling will create pressure to the downside, which in turn causes the first retracement. When the first retracement happens, that's where all the other traders who didn't have the original information, who were a bit late, that's when they come into the picture. They decide to start buying too, and that stops the retracement and the market continues even higher. And this is how the cycles look the same. An advancement even higher, followed by a retracement to the downside where people are cashing in part of their profits, and then followed by another advancement even higher, and so on and so on. Until, obviously, sooner or later, fundamentals change and the big institutions decide that it's time to sell massively. And obviously, this is where you would have the beginning of a downtrend. Now, this gives us a parameter we can use in order to measure a trend. Let me just clear the screen real quick, and I will be able to demonstrate for all of you. There we go. Okay, so if we consider this to be the beginning of our new uptrend, then this would be the first dot, the first point. And now we would need a second one in order to be able to connect the two dots and draw up our trend line. What we can use here is we can actually use our Fibonacci retracement tool. It's a very, very popular tool. It's located right up here. Your Metatrader, or you can access it by going to the Insert menu. Then you have a Fibonacci submenu, and the first entry is the retracement tool. So by connecting the first low to the first high, we'll be able to draw up our retracement lines. Now let me make those a bit thicker so that it will be easier for you to see on your screen. There we go. Now, what Charles Dow said is that people would be cashing in on parts of their positions. And what he said is that in an ideal world they will be closing half of their positions, or between 1/3 and 2/3 of their positions. So we can identify and measure a trend, and we can label it as a trustworthy trend if we see that its retracement, by retracement we mean this, the first retreat to the downside, if this goes back between 33 and 66%, 1 to 2/3. People are cashing in between 1 to 2/3 of their open position. Now, if the retracement is not at least 33 or 66%, this does not mean that it's not a trend line. It would mean, though, that it's either too aggressive and cannot be sustained for long, or it would mean that it's not really aggressive enough. Or in other words, not very trustworthy, shouldn't really count on it too much. But if, as in this particular case, we see that the retracement is exactly between the 33 and 66%, actually getting very close to the 50%, then this would be our perfect ideal scenario. And between the 33 and 66% lines, this is what we are going to call, there we go, our buy range. So this is where all the late traders come in and start positioning their buy orders. Once again, this is actually the beginning of the swing trading, of the trend following technique that we're going to discuss today. So when we see an advancement of the market, we use the Fibonacci retracement tool to measure it from the first low, which is down here, to the first high, which is up here. Now, we've already mentioned that we don't buy on the highs when we're in an uptrend. We buy only on the lows, and vice versa for a downtrend. We don't buy on, we don't sell on the low, we sell on the high. So in this case, we see the beginning of the trend, we see the first high it reached, and now we have to be patient. We have to wait, draw up our Fibonacci retracement, and wait to see where the retracement will go to. Is it going to be between 33 and 66%? Now, I should mention at this stage that the Fibonacci retracement tool by default does not include 33 and 66% simply because they're not Fibonacci numbers. But you can modify the tool, and you will only need to do it once, actually, by double-clicking on it to mark it. Once you've placed it on the chart, of course. Let me just try to do that right now. There we go. And then you can go to Fibo Properties and modify the levels you see there to add your 33 and your 66 levels. Now, once we see that the market actually goes exactly smack in the middle of our buy range, of what we've identified as a buy range, then this would mean that it's a good solid trend, and we can actually place our buy order here as well. Of course, just buying the second we see a 50% retracement in itself is quite risky. We would normally need some kind of a confirmation, or what we call a trigger, in order to enter the position, and that trigger could be the economic calendar, any particular news which are expected. They can actually give the trigger to enter the buy position exactly there in order to catch the second wave of the trend. Or we can also double confirm it with another technical indicator. For example, myself, I would like to use the indicators, oscillators, Williams percent range. There we go. So I would add the Williams percent range myself as a good overbought, oversold indicator. And now if we consider where the market was inside our buy range, we can see that the oscillator is also showing it as oversold, which could be a second confirmation that it's a good place to buy. So in terms of our trend following technique, it is as simple as that. We see a power movement, we see a wave on the chart, we see the market reaching a high, we see that it's starting to retrace. So the only thing we need to do is we need to draw up our Fibonacci retracement and wait to see if the retracement is going to be within 33 to 66% of the original wave, the original power movement. And by power movement, we mean this. You can just bear with me for a second. There we go. So once we confirm this with another technical indicator of our choice or with the economic calendar, and we're sure that we want to enter our long position, the next thing we would need to do is we would need to decide on where to put our take profits. Now, as we just briefly mentioned a few minutes ago, the rationale behind the trend and the way that advancement and retracements take turns is quite simply that when the market goes close, reaches close to a resistance or a support level that bothers people with open positions, they would act, they would liquidate a portion of their position in order to secure, to cash in on some of the profit, which will in itself push temporarily the market in the other direction. So the first more significant resistance level that we see here would be the zero line of our Fibonacci retracement tool. So this is the previous high that the market reached, and we cannot be sure if it would have the strength to push above it. So what we could do, just to be sure, just to be safe, is we can liquidate on half of our position exactly in the middle between the 0 and 23 line, or if we want to be even safer, we can do it, we can put the liquidate part of our position in the middle between the 0 line and the 33% line. Now I've marked where I would put my take profit with, once again, a not so beautiful dotted line on your screen. And there we go. TP, that's where I would put my first take profit, and I would like to emphasize on first. Now why first? Because I don't want to cut my profits, I want to run them. I want to maximize the result from this trading decision. So I'm not going to close all of my position, I'm going to close just half of it. For instance, if I bought 2 lots down in the green rectangle, I would close only 1 lot when it reaches the first take profit line. Now how to identify where to put the second and the third take profit line, I will demonstrate in a second. But before we do that, let's first consider our stop loss. It's extremely risky and a big no-no on the market to trade without stop loss. As we mentioned a couple of times already, we want to run our profits and cut our losses. We don't want to run our losses and cut our profits. So, where can we put our stop loss? Well, if people liquidate only part of their positions, and if a good retracement is between 33 and 66, then below 66 would be an indication of a possible trend reversal. It does not mean if the market goes, if the retracement goes further down than the 66% retracement line, it does not mean that the trend is necessarily reversing. It just means that it's not a very strong one. It means it's losing momentum because people are selling too much. They're liquidating a too big portion of their running positions. And the pressure to the downside might be too big. So what we can do is we can set up our stop loss in the middle between the 66 and the 100% line. So somewhere down here. Stop loss. And this would give us a perfect positioning simply because we enter the market ideally around the 50% retracement. And if our take profit is between 0 and 33 and our stop loss is between 66 and 100, that would mean that they are pretty much equal. So we're not risking much more than what we're hoping to make, which is a very important notion of Forex risk management. And of course, we are going to discuss this in one of our next webinars. Now, what Charles Dow said, that in terms of the trend is more likely to continue than to reverse, is of great significance right here, simply because we are risking an equal amount if we lose, and we are hoping to make an equal amount if we are profitable. But we know that there is a bigger chance to be profitable as the trend is more likely to continue. And obviously, we do have a 33% chance of a retracement just by looking at the retracement here. So we can say that the odds are stacked in our favor. Now, we have positioned our stop loss, we have positioned our first take profit. We should actually also note that this is a first stop loss because we'll be moving that as well. And I see that some of you are asking, how do we how do we proceed with the take profit? How do we manage the take profit? Okay, that's an excellent question. Now basically, there are a couple of ways to do it. You can manually close a position partially through the Metatrader, or if you want to let the pending orders, the take profits and stop losses, if you want to leave the automated system to do the work for you, then what you can do is when setting up your buy position, instead of making just one position, you can make 3 separate positions and set up the take profits at the different levels. But since it's a bit of a lengthy tutorial, what I propose is every one of you who is interested to understand basically how you can partially close a position, how you can set up a few buy orders if you want to follow an uptrend, how to decide which position should be how many lots, and so on and so forth, just send us an email to webinar@gdmfx.com. We'll send you a short tutorial how exactly to do that. Alternatively, of course, you can also watch the introduction to the Metatrader webinar. We do upload all of our recorded webinars in our YouTube channel, GDMfx YouTube channel, so you can just consult the video there in order to see how a demonstration of how you can partially close a working position. Okay, so far so good. As we can see on the chart, our buy decision was an excellent one, and right about here we did manage to hit our first take profit. Now obviously we will need a second take profit level, and we'll need to know how to identify it, how to decide where to place the second take profit. Now let me clear up the screen just a little bit. There we go. In order to identify the possible projections of the trend, how far up it can reach, can be expected to reach, we can use another one of Fibonacci's tools. So you can just go to the Insert menu, top left corner of your Metatrader window. You can go to the Fibonacci submenu and you can select Expansion, Fibonacci Expansion tool, which should be on the bottom of the submenu. And once again, we drag it from the beginning of the trend to the first high, just as we did with the retracement. But then you will see that there is a little appendix there. So we need to position it at the end of the first retracement. So all the way down here. And we will get a second set of lines. I am going to once again make them thicker. And let's see, orange and very, very thick, so it's easier for you to see on your screen. And there we go. Now these are support and resistance level that we should be careful about, and that obviously if we are using the Metatrader, which most of the world is using, and we're using the Fibonacci tools, which again most of the world is using, then we can safely assume that a lot of traders out there would be looking at the same thick orange lines, and they will be concerned about the same thick orange resistance lines. They will be wondering, will the market be strong enough to push higher above them, or will it just bounce off and go back down? So once again, we can be safe to assume that a lot of people would be looking to liquidate a portion of their working position just before the orange resistance level in order to cash in on part of their running profit, but at the same time leave the rest of the position, the rest of the profit to run and hopefully reach even higher. So there we go. Our original take profit was between the 0 and 33 retracement lines, which is the lower dotted line. I'm going to mark it TP1. And then the second take profit we placed is in the middle between the 61 and the 61 expansion line, the first orange line, and the 0 retracement line, or the highest green line. Mark this TP2. So if we bought 2 lots down here, and then we would close one lot on take profit 1, that would be a cash-in of, let's say, well, in this case 200 pips, give or take. That's just for example's sake. And then we would have another one lot still working for us. And by the time it reaches take profit 2, that would be a total of 350 pips, once again, give or take. So at take profit 2, we can close 50% of whatever we have working, which is one lot. We started with 2, we closed 50% at take profit 1, and now we close 50% at take profit 2, which should be half a lot. .5. And obviously between the first and the second orange lines, the first and second Fibonacci expansions, is where we will be able to place our third take profit, where we close everything we have left, which is the last half a lot. So this is how, using the Fibonacci retracement and the Fibonacci expansion, we can measure the trend, we can make our projections and decide where exactly to place our take profits and how to modify them higher and higher in order to maximize the result from this trading decision, if it is the correct one, or if it's not, then at least we would cash in on part of the profits and still end up on a net profit. Now the take profits are obviously only half the story. We do need to remember that we have to work with the stop loss as well. Now the first stop loss was basically placed between the 66 and 100 retracement lines. So down here, stop loss 1. Now when we hit take profit 1, we've cashed in on part of our money. So what we can do is we can move the stop loss of the remaining part of the position between the 50 and 66 lines, or in other words, just slightly below our entry level, slightly below our entry level. So that's going to be somewhere here. SL2, that's our second. That's where we lift our stop loss to. So now after cashing in on half a lot, on one lot, on half of our position, we've made 200 and something pips there, and even if the market reverses and goes all the way back down to the entry level and hits our modified stop loss, we would still be on a very nice net profit, a very, very nice one. That's why it's important for our first take profit to be just below the first high of the trend, simply because we cannot be sure if the trend will proceed even higher or if it is going to form a double top, for example. Now when we hit our second take profit level, we can obviously lift the stop loss on the remaining position even higher. We can put it somewhere below take profit 1, close to take profit 1. And obviously if the market goes back around before hitting our last take profit, our net profit would be even higher. So in other words, through this disciplined and careful management of our trend following position, we would maximize on our profits if we are right, and we would still end up with a nice profit even if we're, let's say, 50% right, even if the trend doesn't continue all the way up, all the way higher and higher. And just to give you an example of that, I will clean the screen. I can see that one of you is asking if we can see an example of a not so nicely working position? Yes, we can. Let's go here. Okay, so we will consider this to be the beginning of our uptrend and this to be the first high. Now, imagine that everything here on the right side of the screen is somewhere in the future. We don't see that. That doesn't exist yet. But we see it. The market is pushing higher, and then we see that it's starting to retrace. So what we need to do now, once again, is we need to grab our Fibonacci retracement from the beginning, the advancement to the first high. There we go. And then we can measure. Now, we see that the trend retraced all the way down to the 66% retracement level, but not below it. It didn't close below it. So we can say that this is a nice trend, nice uptrend, and the price is in a good buying range. Put a little rectangle there. This is what we're looking at. So consulting with our oscillator, for example, on the bottom, we can see that we are oversold all the way here. And let's say that we're not very patient, so we open up here. Our entry level is up here. I'm just going to mark it with an E. There we go. This is where we open our buy position. Our first stop loss is in the middle between 66 and 100. Down here we see that we never reached it. And our first take profit is in the middle between 0 and 33. And this time we see that yes, we were actually able to reach it. So we hit our first take profit. But then we see that the market starts acting weird, up and down, not really pushing higher to the upside. So now let's use the Fibonacci expansion tool and see if we would have been able to reach our second or third take profit. To remember to drag the appendix all the way down to where the retracement ended. And there you go. We can see that the first orange line is actually even lower than the zero retracement. And then we can see that our third take profit, which should be between 100 expansion and 61 expansion, would be somewhere here in the middle, but we would have been able to hit that as well. So yes, my apologies. This was not actually as bad of an example as I hoped it would be, but we were again able to cash in on all three of our take profits. Now, for a change, what we would do is we would consider a downtrend. And once again, it is on the Euro USD. Before we go there, actually, there you go, I spotted a not so good trend. Let's say that this is the beginning, this is the first high, and then we see the retracement. Everything else, this side, not visible to us yet, it's in the future. So what we can do here is, once again, we take our Fibonacci retracement tool, beginning to the first high, we measure where is the buy range, and we see the buy range between 33 and 66 here. We consult our oscillator, and it actually tells us that somewhere here close to the 50% retracement, which is our ideal case, is a perfect oversold entry opportunity. And that's what we'll do. We will enter the market here. I'll mark this with an E. Now, just to make my markings a bit easier for you to spot, I will get rid of the green rectangle. There we go. So our entry line is on the chart. Our first take profit would be in the middle between the 0 retracement and the 33 retracement line, somewhere here. And as you can see, we're hitting it perfectly. Our stop loss all the way between 66 and 100 in the middle, down here. And we're not even close to it before hitting our first take profit. Now we'll go to the Fibonacci expansion from the beginning to the first high, and then the appendix all the way down, lowest point of the retracement, and we can see where the second take profit, which should be between the 61 and the 0 line, should be. It should be somewhere up here. So we are managing to hit our first take profit, and then we're managing to hit our second take profit. But the third one, the third take profit, is all the way up between 100 expansion and 61 expansion, so we were actually never able to get even close to that, and we would hit our modified stop loss after hitting take profit 2. And our modified stop loss is just below the original entry, which is down here. So that's the second stop loss, that's the first stop loss, first take profit, second take profit. Now once again, word of caution, we do modify our stop loss only after we have cashed in at the first take profit. We don't modify it sooner, we don't modify it later. We have to be very disciplined, follow the rules. And as you can see, we hit 2 take profits. After hitting take profit number 2, we modify the stop loss at the third level, which should be somewhere above the 33 and below the take profit 1. That's it. Stop loss 3. This is where we hit our stop loss. And if you consider where our entry point was, you will notice that we're actually hitting a stop loss on a profit. Our position is on a profit at the time when it actually hits stop loss, so we managed to cash in on everything. Now this is why this particular trend following technique is extremely powerful. And this is why, although it originates a century ago, it's still one of the most widely used longer-term trading techniques. Now, because I know that some of you will ask, you can use this on a short term. Of course, you can use it on. You don't have to use it on the trends visible on the daily chart. You can use it on secondary, on intermediate trends, lower time frames as well. But you should bear in mind that, as with most technical trading methods, especially swing trading methods, the higher the time frame, the bigger the certainty. Now let me clear the screen real quick, and I will demonstrate the same technique on a downtrend. I'll clear the screen real quick. There we go. And now we will focus on the downtrend. Let me just show you what I'm looking at first. This is where it begins. This is the first low. This is the first high. Now we do have 2 points to connect, 2 highs. Just to remind you that in the case of a downtrend we connect the highs. In the case of an uptrend we connect the lows. So we have at least 2 highs, and we can see that the second high is lower than the first high. So essentially our conditions have been met. We can say that this is a downtrend. So what we can do here is we grab the Fibonacci retracement and we drag it from the beginning, the trend, lowest point, the first advancement, and then we measure to see if the retracement to the upside would be between 33 and 66, which is this zone here. This is what we'll call a sell range, selling range. And yes, we see that it is actually smack in the middle. Goes just nicely above 33, so it's in the middle of our selling range, and we can see that the oscillator on the bottom is confirming. It's giving us an overbought conditions. So we can consider opening our short position here. Just to remind you again, in the case of a downtrend, you don't sell on the low, you sell only on the high. Now I will remove the rectangle once again. Now let us consider that we have bought here somewhere in the sell range, mark it with an E, and that would be our entry level. Our first take profit would be the middle between the 0 and the 33% retracement. Take profit 1. And our first stop loss would be in the middle between 66 and 100. Stop loss 1. As we can see, we are hitting our take profit level without even getting close to the stop loss. And after hitting take profit 1, we would proceed to move the stop loss closer, just above, the entry level. This will be stop loss 2. Our take profit 2, in order to identify it, we would again use Fibonacci expansion. We drag it from the beginning of the trend, first low, and then we adjust the appendix to the highest point of the retracement. So take profit 2 would be in the middle between the 0 retracement and the 61 expansion, first expansion line. There you go. Take profit 3 in the middle between the 2 orange lines, 2 expansion lines, 61 and 100. Profit 2, take profit 3. So once we hit our first take profit, the stop loss is moved from stop loss 1 to stop loss 2. Once we hit our second take profit, we move stop loss from stop loss 2 to stop loss 3. And then we hit take profit 3 and we're done. 100% in the profit, playing it smart, swing trading a downtrend. It is, as a matter of fact, simple as that. The devil here is to be disciplined, to be patient, and to get your entry right. In order to do that, it does take a lot of practice. As every every single trader needs to basically find what we call his trigger, what would make him click the sell button. Whether it's going to be a double, triple confirmation with other technical instruments, whether it's going to be the economic calendar, whether some other means of making the decision, but that would be the only tricky part of this strategy. Other than that, it's actually pretty solid, widely used, and as we can see, extremely simple to use, and there is clear rationale behind it. We can actually, for once, say that we understand why the market is behaving the way it is, so it's not such a mystery anymore. Okay, excellent. Right, what we're going to do right now, ladies and gentlemen, is I will allow a 5-minute break before we go into the question and answer session. And when we come back, please use the time. Just send us all of your questions. If they're relevant to today's topic, we'll just go into question and answer. We'll answer them right now. If they're not so relevant, you will still receive your answer. We'll just send it over to your email after we conclude today's session. And if something else comes to mind later on, by all means, don't be shy. Just send us an email at webinar@gdmfx.com. My name is Kiril Tsenkov, the host of today's webinar, Trend Following. And of course, it has been my pleasure. I will be back with you in 5 minutes, and we'll take it from there. Right then. Hello again, ladies and gentlemen. I see that you are a bit shy today. In fact, a few of you have wrote to us that they will be sending their questions later on via email. By all means, please do so. It will be my pleasure. Webinar@gdmfx.com. We'll make sure to assist you in the best possible way. Since there are no other questions which you would like to be addressed right now, we would call it a day. So thank you very much for joining Trend Following Like a Pro at GDMfx. This was your host, Kiril Tsenkov, and we are looking forward to seeing you again with our next webinars. For now, have a great day and good luck with your trading.